Is this on?
What's up, world? What's up, world? What's up, world? It's Monday, and we're back for another Mortgage Minded Monday show. It's been a while. I don't know if we did it last week, but it's definitely been a while since I've been on. Been traveling, gathering good information, right? And as you see, two familiar faces, right? But we'll go over to Heisey, right? Let her introduce herself to you guys.
Happy Monday.
Today's
It's
Monday, y'all.
Monday. It's
Today,
Monday.
It's
and I'm gonna guess on y'all show,
It's Monday.
it's
and
a
y'all
you
haven't
know
gotten started yet. Happy Monday.
that's what threw me off because normally when you and I are on together, it's Wednesday, and so autopilot, I'm just like, oh, but it's Monday, so happy Monday. We are here live for Mortgage Minded Mondays. I am Hyacinth Henderson, the co-CEO of the Henderson Financial Group. I am joined by the fabulous, the uncomparable, the amazing twofer Robert Henderson Jr., President, CEO, and founder of the Henderson Financial Group, and Tavares Jones, advisor, mortgage broker at the Henderson Financial Group. How y'all
Got
like?
that right. Got that right. Good afternoon, everyone. I'm
This is
Robert
your morning,
Henderson
right?
Jr. I'm joining Hyacinth today and Tavares. Their show they always do on Mondays. Last Monday they missed. Tavares is out of town at an educational workshop in Michigan. And I'm gonna talk to him and ask him, he learned some great things. I know it was cold at 30 degrees
Oh yeah.
as opposed to Miami, Florida.
Oh yeah.
And I want to ask you about your trip there. How was it? And then how you see both of y'all, since y'all been doing this show, since both of y'all are licensed mortgage brokers, I want to ask y'all some stuff as a layperson would about mortgages and new mortgages and what's going on with interest rates being high as heck and they're trying to come down a little bit. And what do you think forecasting? What do you guys been hearing out there? So Tavares, with that,
Mhm.
without further ado, why don't we tell us this you spent all week, man. We missed you from the office all week from Monday to Friday, learning different mortgage strategies. Did you learn something that you really like that people can use?
Well, it wasn't more so about borrowers, right? It was more so about us as mortgage loan originators
Mm-hmm.
to help us enhance how we approach borrowers, right? And how we get them through that borrowing process
Mm-hmm.
as smoothly and as quickly as possible. So it just gave us some hints to do that. So it was very informative. UWM has a slew of, um, I would say, butlers to help us get through or to help us service.
Concierge,
Yeah,
right?
to help us service you guys as borrowers. So when you guys, contact us at the Henderson Financial Group for whether it be an investment property or your primary residence, we have a whole team behind us to help get things done, right? So whether it be you need a duplex, a single family home, if you need something, in Mississippi, Alabama, even Texas, right? Utah, you give us a call and we can definitely make it happen for you.
All right, that's cool. So now, Henderson Finance Group, with you two dynamic duals, we can also offer mortgages all over the country.
Yes, most
So
New York is a little tight. Y'all know New York is,
New
New
York is New
York, New
York.
York.
Yeah, that's New York.
Right.
That's from insurance to
Hmm.
securities to investments to mortgages. I do understand New York has their own little world, so to speak.
Right.
So with you two being dynamic dual representing the Henderson Financial Group to help our clients, and the reason why I wanted to get into mortgages because we wanted to be able to give our clients more added value and help them through the process. When we do a lot of real estate purchasing and selling for clients, we just want to be able to not hand it off to somebody, some stranger, but we want to be able to keep it in our link where we can actually control and help the client understand the process. So
Most definitely.
that's the reason why I asked both of you all to get more involved in the mortgages. Hyacinth had been doing mortgages when she first got into the business 20 years ago and really got off and just went bunkers and doing mortgages. And then I think in 2008, Hyacinth, you said, no more, no mas, forget this stuff. And then she got really more into securities and securities license and become an investment advisor. So now, I asked her to go back into it. Now she's getting back into it, and you here, you back into it. You're getting it for the first time. So I feel that together, you all and you all, the way you all work together in unison, and at the Henderson Finance Group, it's really going to enhance what we can actually provide for our clients now and in the future. I'm really excited about the future, even though interest rates are low or high right now. What do you guys feel? What do you think? You think it's going to be great opportunity? You think interest rates going to stay high like this? How do you feel? What have you been hearing out there?
Well, I'm gonna go by one of your favorite sayings. You got to use the bathroom sometimes. You got to go to the bathroom eventually, right? So what that means is you cannot just continue to eat and eat and eat and sit at the buffet table and unbuckle your pants so you can add more food and get more room and think that you're gonna be able to sit there forever, because everything is cyclical. So rates are high now. Do I think they're going to be high forever? Also, while our interest rates are high, understand that the rates on cash is high. So we have high yield savings accounts. Credit card interest rates are also high. It's not going to be that way forever, because that's just not the way that economic cycles work. I do believe that we may be here for a few more months, maybe even a year or so, but I'm not, this is not a prediction, right? This is just what I believe, but it can change at any given moment. I know y'all have an election coming up in about a year, right?
Yeah, y'all do.
Yeah, around this time. So all those things play a part in it, right? I think it's a great time. It's always a great time to buy a house. Let me say that. It is always, always, always a great time to buy a house, because one thing that we know about housing and the housing market, especially if your desire is to own real estate, is if you are waiting around for the prices to take a significant decrease, especially in the world that we live in right now, you're going to be kind of waiting and holding your breath until you almost pass out or croak, just because of the environment that we're in now. So if you're out there and your desire is to buy a house, is to buy a property, and you're looking at interest rates and you're saying, well, rates are high, I'm going to wait for rates to go down, I would ask you to be mindful of that. Be careful, weigh your options. Ask yourself, can you afford the interest rates that they're offering now? They're still in the single digits. Thank God they're not in the double digits. Can you afford that interest rate? If so, then you have to look at your finances and make a decision to say, hey, maybe I want to get in the house now, because while I'm holding my breath for interest rates to go down, when that finally happens, it is a possibility that home prices, the houses that I want now, their prices would have increased. So, it just depends on someone's personal situation. I received a call last week, I think it was Friday, and I had a call with a new client, and we were having a conversation, and she was thinking about pulling some equity out of her commercial property. She has loads of equity in her commercial property. The equity is available, the opportunity is available for her. Her credit says that she can, and she was thinking about paying off her current mortgage, which is at about a 9.5% rate, and then pulling equity out and obtaining a new mortgage. And I said to her, well, let's do the math. Let's think about this. And in her case, because she didn't have an immediate need for the equity, she decided to think about it in different ways. So I just shared that example because everybody is different. It depends on your personal situation and circumstance. What I will say before I pass it back to you, gentlemen, is do not allow external circumstances and what the talking heads are saying on the news to be the determining factor of what you do, right? So we look at what's on the table. We know that interest rates are what they are. We know that home prices are what they are. Now let's take that back and look at your personal circumstance, your personal situation, because what you don't want to do is to look up 12 months from now and say, gosh, I shoulda, coulda, woulda, right? Because we know that when rates go down, we can do something called refinance and then get a lower interest rate. So I don't know what's going to happen, but I think that everyone here listening should be thinking about their personal situation and making an informed decision that way.
So let me ask you guys, do you think that it has always been before, since I've been in the business for over 37 years, is it still income and credit is the first, like the door stopper, the beginning, the x-ray, the exam before when it comes to borrowing money? Is it still, let me look at your income and let me look at your credit? Is that still a prerequisite for being able to qualify for a loan?
In most cases, yeah, right? So in most cases, yeah, it's kind of like dating, right? So everybody want to date an attractive person, right? So you got to have a nice looking face, and you also want to have a good character about yourself. So a good inside and a good outside. Good inside would be equivalent to a good credit score, and a good outside would be equivalent to your income, right? Now, lenders, before they lend their money out, they want to make sure that you are worthy of their funds, Now there's some ways to go around it where we can get creative depending on the loan type that you are purchasing, right? So if you want to go, let's say you want to purchase a income producing property, right? They have some some wiggle room where you can go with less documentation, right? When I say less documentation, meaning, you know, your credit report, your pay stubs, your income, the whole nine, the tax returns, all that good stuff. So there's ways that you can go around it using a DSCR loan, a debt service coverage ratio loan. Heisey and myself spoke about it a few shows back, maybe a few months ago now, where your credit score is important. However, your income is not. As long as you have enough income coming in on that income producing property to cover the mortgage, right? So if let's say if you're bringing in $2,000 in income and your mortgage is $2,000 per month, then that right there can qualify you a loan, right? But of course you want to have a decent credit score. It doesn't have to be, you don't even have to be in the 700 club, but the higher your credit score, the better, of course. So,
okay, so because you said a lot of words.
Okay.
So I like to paint pictures.
Okay.
So when I ask the question is, you know, the first exam that a person has to take when you want to borrow money is they want to look at your credit and they want to look at your income being ability to pay. Do you have money to pay? And your credit, have you kept your word, and have you had experience in borrowing money and paying people back? So they want to look at those two. But that the determining factor with that weighs heavy, I'm thinking, on a primary residence. That exam really weighs heavy on a primary resident, like your home you want to live in, correct? Yes. And it's a little less heavier if you're looking at borrowing money and the situation changed, not on your primary residence to buy a new home, but to buy an investment property. Is that accurate to say?
Yes, and let me add a note before we expound on this topic a little bit. Especially for primary residents, income is going to be very important. It's going to be very important. Before, years ago, when I did mortgages, the way that we can qualify using your income was standard, by the book, vanilla, meaning tax returns, W-2s, pay stubs. Those were the only ways. It's changed now, even for primary residents. So when I say income is going to be very important, let's talk about income and understand that the amount of income that you make is going to tell the bank how much you can afford to pay for a housing expense. Let me tell you why.
And right now we're talking primary residence, correct? Primary
residence, because it's a great example. I've been speaking with someone who wants to buy a new home. She wants to buy a house, her first house after some years. So she qualifies as a first-time home buyer. She has high 700 scores. She saved $100,000. She makes less than $30,000.
Wow.
Income, her amount of income, although she has the credit, she has the savings for the down payment in South Florida for the type of house that she wants to buy. The area, her budget, she told me, was $400,000. When I pulled properties in the area that she wants to look at, the lowest property I saw was $500,000. So when we talk about income, I want everybody out there listening and to be aware that your income does matter, even if we have special programs, because your income at the end of the day says how much you can afford. It's going to tell the story of the amounts of house you can afford, regardless of what you want. Hyacinth, I got to have a big backyard for the grandkids. Hyacinth, I must have 4 bedrooms. Hyacinth, I need to have a 2-car garage. I understand that, but you can't afford that. So I'm glad that
because of income.
So when you talk about income, Mr. Henderson, such a wonderful topic to bring to today's conversation.
But I want to make sure, because, you know, you guys in the field, professional, you use a lot of terminology. I myself, I'm a visual learner and I'm a visual teacher. So that's why I want to stop you guys so you can make it plain to the audience. So when you're talking about mortgages and how you approach it and the determining factors, it's safe to say it depends on what you're trying to do. Those parameters change based on what are you trying to do. If you're trying to buy an investment property or if you're trying to buy a primary mortgage, then the rules and the regulations and the parameters change based on what target you're trying to hit. So there are certain rules, guidelines, methods to use for a primary mortgage versus an investment property, correct?
That's correct.
And I think most people, lay people, everyday people, they don't quite understand that. That's not. And I always say, I think this stuff that we're talking about right now, I think it should be, in grade school. How true financial literacy really works, because these are I don't care if you want to be a doctor, a football player, a hockey, sports player, entertainer, or a nurse or whatever. We all need housing, and we need to know how to finance housing. So I do think this should be one of the prerequisites before you graduate high school, certainly from college, because a lot of people come out of college with master's degrees and they don't even know what a mortgage is, and they need a house. So I know that this is not talked about because someone forgot to talk about it. I know the system is designed to do that. So that's why I want to hear. I want to break it down like a 6-year-old and talk about it. So income and credit plays a huge part on when you want to purchase your primary mortgage, a mortgage that you're going to accompany a house that you want to live in for you and your family. All right, now let's go from that. We know income and credit. Now let's go to let's say you already have your primary mortgage, but now you want to start getting some investment property, because you heard real estate can really be very profitable inside of your portfolio, aside from your 401k. You can real estate. So let's say now you see a piece of property, and this piece of property, let's say, is near the college, and this property is let's say $400,000. Now, and this property is being rented out. So that parameters and those qualifications, you guys will look at it totally different than if it was a primary residence. Am I right?
Yes. So the income would be important, but not the income from that particular person, right? So the income would be from that property in this case.
Okay.
You follow me? So income is still a determining factor. It's just the source of the income.
Okay.
Is where the funds are coming from. So since it's an investment property, what we could do is we can do, as I mentioned, a debt service coverage ratio, a DSCR loan type.
So what does that mean? Does that mean, in other words, let's say that if it was a $400,000 property, and let's say the person has $100,000 to put down.
Yes. So
now we know that they're going to finance $300,000. Right. You figure $400,000, you put down $100,000. That's already 25% of the purchase price. Right. 25% of 400,000 is 100,000. So it's not 10% down, 3% FHA. In a loan like this, you got to tell people, if it's a $400,000 property, it's a commercial property, then you got to put down minimum 20 to 25%. Is that clear? Is that the norm?
Well, the larger the down payment, the better your terms, right? So in that loan type, you have more control over your interest rate, right? So the larger your down payment, the better your interest rate. It's kind of like you're buying down the interest rate. You have more skin in the game in the lender's eyes, right? So you're showing the lender, hey, I want this property, and I'm also willing to take some risk with you, right? I know you don't know me from a can of paint. I know this loan type doesn't require extensive documentation. So what I'm going to do is I'm going to put a large down payment down, right? 25%.
Just to let you know I care.
Right. And I'm in this with you, right? And yeah, so when you do that, you can actually get a lower interest rate in doing so, right? The smaller the down payment, opposite, you'll have a larger interest rate.
So is it a slam dunk fact etched in stone that if you buy a $400,000 rental property, you have to put down a minimum 20%? Are there companies that, are there properties that, there are cases that you can put down 10%?
Not for investment. Okay,
so investment, you always say that across the board, if you want to buy an investment property, let's say a rental property near college is $400,000, you're saying right out the door, the qualification would be to put down at least 20 to 25%?
Right.
Yeah.
That's what yes, that makes sense.
There's no FHA loans out there that you could, that you can put down less?
Well, FHA is full doc. Right. And then FHA, you have to live in that property for a year or so. So that won't be investment. Right. So FHA would be more so on primary side. Okay. Right. So you have some conventional loans where it'll be full documentation. When I mean full documentation, they want to see your tax returns. They want to see your W-2s, your 1099s, your credit, your income, all that good stuff.
What if people investing don't have time for that?
Okay, well then it's going to be DSCR 20% on the low end. Now,
so an example I gave, a $400,000 property near college. the client puts down 25%, which is $100,000.
Yes.
Now they're going to finance and ask the bankers, listen, give me $300,000. Now let's say on a $300,000 with the interest rate being, let's say what it is right now, 7.5, because it's come down from 7.67 to 7.7. So it's down a little bit since the Feds did not heighten interest rates. They kind of cooled it to see what happens. So let's say on a mortgage like that, $300,000, 7.5. Let's say that you're looking at $4,000 a month.
Okay.
That's the payment.
Okay.
But that property is bringing in $6,000 a month.
That's beautiful.
So in a case like that, the client would not need to show, their financials.
Not at all. So you'll just have to show a lease or some type of proof that shows that you have that property is going to produce that
$6,000. It's going to produce $6,000, and the mortgage is going to be $4,000.
Right. So if you got bank statements that show you the tenant's been paying you that amount,
yeah.
If you're doing a refinance, so if you refinance and say you want to pull equity out of your rental property, let's say this rental property is free and clear, but you don't want to show documentation on it. So you're not purchasing this rental property. You actually you're refinancing this rental property to pull equity out to maybe even buy another rental property, right? So if you can show bank statements to show the tenants have been paying you $6,000 per month, that's good proof, for the past 12 months.
So then it qualifies on its own.
Yes.
But what if it's a new property that you're going to get? You see a property out there and it pays for itself, and the seller wants to sell it. The same situation is a $400,000 property, and it's bringing in $6,000. Then they would require the documentation or the history of payments from the seller.
Well, they'll do an appraisal. So they'll appraise the value of the home, and with that appraisal will come an appraisal of income as well.
Okay.
Right? So they'll appraise the income to see what you can get in that area. And if it comes in shy of that amount, then leases can always back that up. So if you got a rental agreements between you and the tenants that are showing, hey, I'm going to pay for this property in between, January 1st and December 31st in the amount of, $6,000 per month. Can now to cover you as well. So appraisal and also leases can cover you.
Okay.
To show proof that you have.
So in buying investment property, as long as the property is paying for itself and there's some cash flow, you don't have to go full documentation. Is that correct?
You got to have a solid down payment, right? So you got to have some cash, and you also want to have a strong credit score. Remember, credit it's going to follow you whatever loan type you're looking to do. Remember, you are looking to borrow someone else's money, and your credit score is your report card to show how reliable you are when it comes to borrowing those funds. So your credit score is going to follow you all over the place.
So Hyacinth, when you're talking to this person, their credit score, is it good? I mean, what is the I would say the bare minimum in order to get for a credit score, in order to get a decent a decent rate? What would you say? 680, 650?
Right. So everybody's definition of decent is different. But before we go there, let's go back, because I don't want anybody listening here to be confused. I know that we're giving out a lot of information. Please understand that we are mortgage brokers. That means that we have access to so many different lenders with so many different loan programs. So we may be talking about a loan program that you may have never heard of, or your lender may have never heard of. And we also can get very creative with that. So speaking about FHA, if the person wants to buy a house via FHA, and it happens to be a 2-unit, 3-unit, or 4-unit, and they're a first-time home buyer, they can put down 3.5%, get in that house, live in one of the units, and rent out the other units. So I want everybody to be clear on that. However, you cannot use an FHA loan and say, I'm going to live in that property and not live in the property to get 3.5% down. And let me explain to you why. Now, back in the days, people did it all the time. People could
yes, they did.
But here we live in such a quickly advancing technological age where everything is shifting. So back in the day, you could say you were going to live there and the bank would know. Now you can bet your funky Watusi and your firstborn child that when you say, okay, I'm going to live there, and FHA says you have to live there, there are time requirements, and you think that you are out slicking the bank, you don't move faster than technology. You're not going to be able to outslick technology. So if you're going to live in the property, one of the units, then yes, you can become an investor, because the other tenants will be paying rent in the other units. Now, when you say what's a decent credit score, it really is going, excuse me, what's a decent interest rate? If we're talking about investment properties, I like to tell my borrowers that we are more so concerned at covering the debt, because an investor is going to think differently than someone who's living there in a primary residence. Because let's be honest, when we're talking strictly investment, 7.5%, no baby, that's what they paying for primary residence. Invest, you want to be an investor, you want to get an investment property, no problem. But 7.5%, either you're going to buy it down, you're going to pay a couple $1,000 to get that rate, or understand, because it's an investment property, you're going to have what we call hits. So the base rate, when we look at rate sheets, the base rate could be 7.5%. You can get hits or you can get credits. High credit score, we're going to give you a credit. We'll shave some off. Oh, investment property, we're going to add something to the interest rate. Oh, you only want to put down 10%, we're going to add something else to the interest rate. Oh, you don't want to show your personal bank statements and pay stubs, we're going to add something else to the interest rate.
It's a give and take.
And then at the end of the day, what is going to determine whether this is a decent or a good, and I'm air quoting good because there is no good or bad. Let's change that. At the end of the day, what's going to determine whether this is an acceptable interest rate is going to be the income that's coming in on the property, right? So with this interest rate, if I'm collecting $2,400 for each unit times 4, is this a decent interest rate? Is this an acceptable interest rate? Absolutely. Now, if I'm collecting $1,500 times 4 with this interest rate, it's not acceptable to me. So you have to expand our minds a little bit when we think about interest rates, when we think about credit scores, when we think about down payments and things like that, because it's no longer black and white and cookie cutter. Tavares, I love that you brought the DSCR to this conversation, because back in the days, and saying that you can use the property income to qualify, because back in the day, let me tell you something, the only way you could use the property's income to qualify was if it was a commercial loan, and commercial is 5 units or more. If it's 5 units or more, that's the only way you could use. Back in the day, you needed to qualify for this property as well. So the DSCR loan is something that has evolved. Just like I said, technology has evolved. And you have to think about all the different aspects that come along with it and the requirements of what they're asking.
So there's more opportunity now with the loans now on rental property if it's not 5 units or more, if it's 4. So let me ask you guys, how do you feel about AI and the effect that it's going to have on qualification? What do you think about it? Have you been hearing, have you been seeing how artificial intelligence is going to be used to do it quicker or faster, or to say, nope, is it going to take longer? Are you going to be able to speed up this thing quicker based on AI understanding a borrower's financial habits and backgrounds? What do you think about that?
You take that one or you got it?
You go ahead. I just talk.
Okay. So AI is impacting the world as we know, right?
Artificial intelligence
in several different industries. However, it's very new into the mortgage industry, and then since there's so much money at stake, so people are buying homes here in South Florida, like Heisey just mentioned, $500,000 on the low end, right? All the way up to millions of dollars. So it's very risky right now for lenders to solely rely on AI. So there's still underwriters, and there's lots of people that's hands-on, right? So I just came from UWM, and they have over 7,000 employees, right? 7,000 employees. So if that right there is very telling to me when it comes to AI, because if they were leaning more towards AI, then they wouldn't have so many employees. That's a huge amount of people to work for.
7,000,
right?
Correct.
So they use it in some instances, like there's a software that's used, an AI software that's used for appraisals, right? So UWM has a software system that you can plug the address of the property in, and if it comes back within a certain range, then the borrower wouldn't have to pay for an actual physical appraisal, which is that's incredible. So an appraisal can be $600 to $800 depending on the size of the
Are they
house.
going to pass that on to the consumer in terms of a property where a consumer doesn't have to pay for an appraisal?
Yeah.
So they'll use an AI, artificial intelligence, to say this property. So in other words, they don't have to look at Zillow.
Right. It falls into a tight range. As long as it falls into this tight range, then you don't have to pay. The people that were there with me, they didn't have too many properties that fell in that tight range. So I don't know how many, properties fall in that window of values that.
So when you say fall into that range, it has to be a certain amount, a certain value?
Yeah. So the system is going to give you a range. And say, and the property has to fall within a
500 to 700,000.
Yeah,
Let's say like that. In
yeah,
other words, $150,000 house, they're not doing it.
Yeah, well, it comes in decimals. They spit it out. The system spits it out in a decimal, and it has to be between less than 0.20. And there's some AI generated numbers in there, but it's going to tell you what the number is. It's a decimal number.
Okay, for the people who are listening to us, one good thing I like about what the Henderson Financial Group, well, not one, several good things I like about what the Henderson Financial Group, we steady growing, and over 30 years we have definitely changed. If you was working with us, 10 years ago, we're a different company because we learned more, we developed more, we're growing, we stay on the cutting edge. And Tavares was spent a whole week in Michigan, going over with a huge mortgage company that does mortgage businesses all over the country. And Heisey went last week. Are you going again this month, Heisey? Are you going, or was it next month?
This month, at the end of the month. Yeah,
Heisey's going again at the end of this month, and it's extensive training. Now, what I want you all to understand is, since the Henderson Financial Group, what we do is, imagine you want to take a airline trip, and you either call the airline, Delta, American, or Southwest, or you can look on a board. You can call someone, and a lot of people use Experian. Who do they use? Priceline, or they use what was the other one? Expedia, Booking, to look at the different rates. Well, with that same, just look and see who has a better rate going to New York or Chicago on a Monday or Tuesday, whatever. That's kind of like what we do at the Henderson Financial Group. We'll look and say who has the best rate and the best company to take your deal through based on where you live and what you want to do and your qualifications. If you have a low credit score, we know not to take you to American Airlines. We know to take you to Southwest or something. If you have strong down payment, then we can say you need to fly. We need to take it with this mortgage, and we need to do that. And that's why I like what we do, because we're just looking and we're trying to be able to not steal you. We don't work for any of the mortgage companies. That's why I want to say we don't work for any of the mortgage companies, but we are watchdogs to see who got what and what's available. And we tie it up to you, a Henderson Financial Group client, because we know your financial situations. That's what makes us very valuable, rather than just calling someone out of the blue. We know your attitude. We know your number. We know your cash flow. That's what having a financial planner. That's what we do. And the industry is moving toward that more, this all-in-one, and having a relationship with a financial planning company rather than just going to Vanguard or going to Merrill Lynch. People want things and people to know them and have a relationship with them so you can take care of their holistic financial planning, from wills to trust to investments to college education. That's what we do at the Henderson Financial Group. So that's why Tavares and Hyacinth is really putting a lot of time and learning this, because housing is a big thing and real estate investment is a big thing. And we think that it should be part of your portfolio. Even now, we buying a lot of raw land, not so much in South Florida, because South Florida is astronomical. And I say South Florida, I mean Dade, Broward, and Palm Beach. So we've been buying a lot of land elsewhere. We want to tell the clients about that, because we're going to have a show to tell you, once we help you to buy the lots, buy the duplex lots, or buy, an acre or 10 acres or whatever, we want to show you how to get it financed. And Hyacinth and Tavares is working on the construction loan process. So we're going to bring you in the future a show about the construction loan process and what are the prerequisites and how you qualify and how to get that done, because it's very important. Like I always said, the Henderson Financial Group, we're not just here for now, but we're here for the future. We bring your future into the present right now. Does that make sense?
Yes.
Got it. All right. So now y'all said AI. So AI is in here is steady, working and helping us. Because when you say, "Hey Siri, how cold?" When I said that, my iPhone Siri just lit up. I have my phone right here, and it lit up. Hey Siri, how cold is it? Hey Siri, how cold is it in New York City? 47 degrees right now in New York. So that's AI. That's really AI. So AI is really in Google. Who is it? Alexa? All
Yep.
that's AI, you know?
Mhm.
Okay, so another
Mhm.
question I wanted to ask you guys was what about if you have a child, a daughter, or a son? Tell us more about this gifting, and you want to help them to get their first property in terms of if I wanted to gift them $50,000 for the down payment,
Mhm.
they still have to come back to whether they're going to be able to carry the debt and the income still going to income and still going to relate to credit, or can they write off me?
Yeah, well, the beautiful thing is gift your child $50,000 to buy a house. I think that's amazing, right? I think that we should do more of that, especially in our cultures, right? Speaking of our type of people, we should do that. I love that. The down payment, as Tavares mentioned, is going to reduce a couple of things. It can reduce a couple of things. It can reduce the interest rate that you pay, and the interest rate that you pay is going to heavily impact the amount of your monthly mortgage payment. So it's phenomenal that you gifted your child $50,000 and it reduced their down payment, which reduced their interest rate. But that monthly payment, their affordability of the monthly payment is still going to go back to their income. So now let's say your daughter said they in their mind, they said, you know what, I want to buy my house and I want to do FHA and I've saved 3.5%. And when they ran the numbers, 3.5% gave them an interest rate and a monthly mortgage payment that they couldn't qualify for. That was too high for their for their affordability. However, here comes daddy being a good daddy and saying, let me give you $50,000. And so the child says, oh my gosh, great. Now, Mr. and Mrs. Mortgage Broker, Tavares or Hyacinth, instead of 3.5%, I can put down $50,000. And the mortgage broker says, wow, let's see how that affects your debt to income ratio, your DTIs, your front end, your back end. However, your monthly income is still going to be used to qualify for that monthly mortgage payment. Does that make sense?
Yes, I got it. Good. Okay. All right. So I got another question for you guys in terms of mortgage. I got lots of questions. So that's why I'm a guest on y'all's show. Ladies and gentlemen, this is the first time I'm being a guest on Hyacinth and Tavares' show. I told them, let me come in on a Monday when y'all talking about mortgage and drop in like bruh man from Martin and just drop in and just ask y'all some questions. You know, one of the mortgages that I like, and a lot of people still don't know about them, is this first position, all-in-one first position HELOC mortgage. I want to talk more about that because a lot of people know about if you have a piece of property and you want to, and you have equity in it, and you need to get some cash out of it. You go to the bank and they'll give you a second loan, or some of them are fortunate enough to get what they call a HELOC, okay, a home equity line of credit, right? But we really like something that we feel more superior than those, and that's called a first position HELOC. Can y'all explain to the audience what's the difference and why do we like the first position HELOC? What does it mean to the bottom line and in the end?
That's a great question. Okay, so the first position HELOC.
And I want you to tell her into the story. You can use me as an example, okay? That I think if you use me as an example, and I'm a customer,
okay,
and then I'm going to tell you my situation. I think that the audience can relate to it and see the visual and walk it through, okay? Because the story, a picture is worth 1,000 words, okay?
Okay.
So Mrs. Tavares, I have a house. My house is worth $600,000. Okay, and I have a mortgage, and I only owe $200,000.
Beautiful.
And I really want to pull some equity out because I want to buy this property that's in Tallahassee, and it's near the college, and I know I can rent it out. So we know my house is a $600,000 value, and I owe $200,000. So that's $400,000 in equity. That's $400,000 in the walls, like we say. And I come to you because my banker said that they can give me a line of credit. A second mortgage. And they're going to charge me, 8%. Now, do you think that's a good deal or can you do better? The reason why I say, can you do better? Because at the Henderson Financial Group, we'd like you to ask us a question before you make some moves. Before you make some moves, we'd like you to call the Henderson Financial Group and say, is there a better way to do this? So I'm calling the Henderson Financial Group and I'm saying, Tavares, Hyacinth, based on the information I just gave you, It's there because my banker said they could do a second mortgage and pull equity out for 8%. And the type of equity that he said that I can pull out is, he said I can pull out another $200,000, $300,000, $300,000 at 8%. Now, would you suggest I do that?
Okay. Now you have options, right? And that's the beautiful part about it. So that traditional HELOC that your banker told you about, there's an alternative to that, right? So that's more so a JV HELOC, right? So in high school, you have junior varsity and you have varsity, right? So junior varsity, there's limits, right? You don't play as many games. You don't get as much exposure to colleges and things of that nature. The games moves a lot slower, right? You still get experience of playing on the field, which is good. However, it's not like varsity, right? So you have the details of the junior varsity. Well, you just explained the details of the junior varsity.
So you're saying the thing that the mortgage, the second mortgage that the bank's going to offer me, they are what we call junior varsity. They're not superior than what you're going to offer.
That's correct. That's correct. Not bad. It's just there's another option out there.
Is that 90? That's 95% of what people know. That's all they know.
Right. And that's like a stock engine, right? So my car guys out there, right? That's just like buying a car off the dealership. You may buy a Dodge Charger off the dealership, and whatever motor that car comes with, that's going to be the junior varsity HELOC. You can still get from point A to point B. But
so tell me how you can do something better, because it's a bank, and they said that since I have all this equity and my payment history is good, I owe $200,000 on a $600,000 home. I want to pull out another $300,000, and you're saying that you could do better than that. Tell me how and why.
Okay, so there is an option, right?
Okay.
So this varsity option, still a HELOC, right? Now, what it's going to do is, instead of you having two payments as you would with the junior varsity HELOC, you'll have a traditional mortgage payment to pay down that $200,000, and then whatever you borrow on your HELOC, you have two different payments.
So I have two mortgages,
right?
Two mortgage payments every month.
And if you anything like myself, I don't like making my one mortgage payment, right? So imagine having two of them, right? So with this varsity HELOC, what we're going to do,
you're proposing,
yes, we're going to pay off your traditional mortgage. We'll get rid of that. Right, and we're going to put it inside of the HELOC. So now the HELOC is going to be $200,000, right? That's the base. And then if you decide to borrow anything additional from that, because you say you want to purchase a rental property, right, in Tallahassee. Now the property.
So hold on, I'll make sure. So what your strategy is, instead of having two different loans,
yes,
you want to do one loan and combine the loans together to have one payment.
Yes, one payment.
Okay, I get that. I get that. That makes sense. Okay, now you have this one payment. So let's say I owe $200,000 on my original mortgage. You're going to pay that, and I'm going to start paying your one mortgage on that. And then any equity, if I want to borrow $300,000, I'm going to have the $200,000 new money and the $300,000 new money that I want, and then I'm going to have the $200,000 old money that I got to still pay for. So totally, I got $500,000 one payment.
Mortgage, yes.
Okay.
So at closing, you can pull out the $300,000, right? Because this HELOC is going to go through a closing process, right? We'll have to collect some documents from you, and then you can say at closing, hey, I want to pull out $300,000 so I can make that purchase of the rental property. So at closing, two things will happen: your traditional mortgage, or your mortgage, will be paid off, and you'll get a check for $300,000.
And I can go and buy that property in Tallahassee for cash.
You can go buy the property in Tallahassee. So your HELOC amount, it's going to be $500,000, right? And you'll make payments into it just like normal. It's a strategy behind it, but I don't want to go deep into those, right? So you'll make your payments into it like normal. And as you make those payments, right, for one, the payments that you make into your HELOC, they go directly to your principal, unlike a traditional mortgage. And that's where all the meat and potatoes happen. So when you have a traditional mortgage, your payment is split up into different buckets, so to speak, right? So you have principal, right? And that's how much you owe. So if you owe $500,000, whatever of your monthly payment is going towards principal, that's how much your mortgage is being reduced by, right? And within the first 15 years of your mortgage, most people don't know that most of your monthly payment is going towards interest instead of principal. So that's why it takes a whole lot longer
30
to pay
years
off that property. And in that 30 years, a lot of times people focus on the actual interest rate, right? And that's a complete blinder. That's like having a bandana over your eyes while you're driving, right? So banks have forced you to focus on a 4% rate when there's a dollar amount tied to it. So anytime somebody, you want to get a dollar amount of that 4%, right? So whatever your interest rate is, because you got to pay that 4% over 30 years. And as I mentioned, you're going to be paying interest first for the first 15 years. So your principal is not going to be dropping much for the first, half the half time frame of your mortgage.
So the strategy that you would propose is get the HELOC that you're proposing, because your payment is going to be paying more of the principal. It's going to be knocking that debt off first.
Yes.
Therefore, that's why instead of paying that same mortgage off in 30 years, you can probably pay it off in 10 years or less.
And not only 10 years or less, you'll also save a whole lot more money over the life of the loan, right? So the interest rate may be a little bit more, right? But you can still pay the loan off faster and save money over that time frame of you paying off.
And see, this is a lot of people don't understand, or they don't know. The problem is, Hyacinth, is that people don't even know what they don't even know that they don't know. So therefore, they don't ask. They don't even know that you can do this. Unless you are working with a financial planning firm like ours, we'll be able to tell you there's other things that you didn't even know that you didn't know that's available to you. That's what I like at the Henderson Financial Group, what we do. Now, would you recommend in that situation that I just put out, would you recommend the all-in-one, just one HELOC also? Would you recommend, and could you explain us why you would recommend it also?
So what I would ask you is, what do you want to do? Like, what's your objective? And sometimes people are so programmed and conditioned to tell people what they want that they don't know why they want to do it. And so when you ask, why do you want to do this? Why do you want, they get tripped up, and sometimes people get offended. So my recommendation on whether you should do this varsity HELOC versus a JV HELOC would be, what is your ultimate goal? Like, what are we trying to accomplish? And if you say, well, Hyacinth, I am trying to accomplish where I can use the equity in my home, not overpay the lender in interest, because I know with the traditional mortgage, I'm going to pay a ton of money in interest and I don't get to pay off the principal until later. And I want to be able to make sure that I'm making a financial decision that allows me to use my money in a way that helps me grow my wealth. Well, I would present both of them to you. Tavares, I'm so glad that you started talking about, and you didn't say this word, but this is the fancy word, the amortization differences between a traditional refinance and a HELOC, the varsity HELOC. Because here's what I heard somebody saying in the audience. I heard somebody saying in the audience, well, okay, I understand you saying that I don't want to have my regular mortgage payment plus an additional 9 of credit, because Tavares, I'm like you, I don't want 2 payments. So I get that part. I heard somebody saying I could just go refinance. I don't have to do this special varsity HELOC. I could just go refinance and get a lower interest rate, because a regular refinance is going to give you a lower interest rate, because that's the Jedi mind trick, right? And so when people think that and they look at the varsity HELOC interest rate, and then they say, I can just refinance to get it. But the lower interest rate does not mean that you are making lower payments over the life of the loan, because of the way the loan is amortized and the way that the payments are applied. So if you came to me, Mr. Henderson, and said, hey, this is my situation, what I would do is I would ask you your why behind the what. Why do you want to do this? And once you explained your why you wanted to do X, Y, Z, then I would show you 2 options, because it's never about convincing. I would say, listen, we can do this the traditional way. Here's your interest rate. It looks attractive. Like, we're going to let the smooth taste fool us, right? We know what happens when you let the smooth taste fool you. It tastes good for a while, but then it's on your waistline for a long time, right? So we're going to let the smooth taste fool you with this 4.5% interest rate. But when I show you that TIL, that truth in lending, and show you how much you're actually going to pay with that smooth taste, you might be like, what? This is what I'm going to pay over time? And then when I show you the varsity HELOC and say the interest rate appears to be higher, because it is higher, but let me show you over time the amounts of money that you would have saved, then I'm going to say, what you want to do, boo. I presented both situations to you. We're going to educate you. That's one of the things that we do here at the Henderson Financial Group. We want to know the why behind the what. We want to educate you. We're going to present the situations to you and then allow you to make the decision that you believe aligns with where you're trying to go.
Tracy asks, does it have to be on your primary residence?
It can be an investment property. It can be an investment property, yeah.
So, it doesn't have to be on your, the answer, Tracy, that does not have to be on your primary mortgage on your primary residence. It could be an investment property.
For up to 4 units, though.
Up to 4 units.
Mhm.
Okay, 4 units. Can't be 5 units. That's commercial property. But it could be up to, a house, a rental house. It could be a rental, 2-family house, a duplex or triplex, or even a fourplex. Then this right here is fantastic. We use them, and it's astounding how much money you save in terms of your monthly payments on interest and how much money you pay toward the principal. So, that takes me to something else I want to ask you guys. Back in the day, we used to use a lot of interest-only loans. Is that still out there, interest-only loans? Do you see financial institution offering them? Have you all interest-only? And I want you all to explain to the audience, what is the pros and the cons of interest-only? And I'm going to give you an example. I come to you and I say, listen, I need to borrow $300,000, and I don't want my payments to be high, and I need to borrow this, but I don't want a high payment. And if I say, how about an interest only? Tell me the advantage of that, and tell me the disadvantage of it. Can you guys tell me that?
I can. You want to take it to you? What do you want to do? What you want to do?
You got it, Heise.
Okay, so again, and y'all know I Mr. Henderson, I'm long-winded. That's how I do the clients when they call.
I got another question, so don't be long-winded because I got something to back that up. So what's the difference? First of all, the question was, I want you to tell the audience about, because there's different ways. I used to say there's different ways to skin a cat, but I don't want the animal people calling me. Okay, so there's doing things a certain way. It depends on how you do it. That's why I say it's good when you call the Henderson Financial Group and say, I want to do this, and I want to know what's the best way to do it. That's what we do. We're good at that. That's what we're planners, we're thinkers. So I'm asking, what is the pros and cons of an interest-only loan?
Let me say this too. I love when you say that's what we do at the Henderson Financial Group. We're planners and thinkers. Our ideal client is someone who is of a higher consciousness or is open to increasing their consciousness. Let me tell you why this matters. Okay. This is very important because we don't want to make you, and we understand that in the history of the earth, that there are standard ways of doing things. And a lot of people have been conditioned and programmed to believe that that's the only way and it's the right way to do things. So when you think about doing something different, it feels really weird and it feels like you want to label it wrong and incorrect and bad advice. That just means that you're not of this consciousness and you're not open to raising your consciousness to understand this. This goes back to that special varsity HELOC that we were talking about. We didn't get into the details of it, but you need high 700 scores to be able to qualify for that. And the reason is because they want people who have a certain consciousness and who play in the big leagues to be able to say, oh, okay, I get it. I'm not getting ready to keep going back and forth with you about, but why my rate this and this and that, and my cousin Tink around the corner can get this, baby. Once you have worked to get your credit score to where it needs to be, we are going to believe that you have the consciousness to understand why this program runs this way. Now, this is going to be applicable for interest only too, because I love the example you said, listen, I want to keep my payment as low as possible. The average person of average consciousness, either you are conditioned to be this way and or you refuse to expand your consciousness, you're going to say, why would I want an interest-only loan? I'm paying the bank all this money. I ain't never paying off the principal. I don't want that. I want to pay my house off as soon as possible. Hold on. Let's talk about consciousness. Because if you are of a certain mindset, you probably might say, I don't never want to pay this house off in my lifetime. Give me the interest-only loan because I understand luck and I want to have luck, liquidity, use, and control of my money. And when you tell me the traditional way, average people, average consciousness, you just ain't get there yet. $300,000, give me something fully amortized. I want to pay principal and interest, and I want to pay it off as quick as possible, and I want to pay all my money to this. you're not really using your money to the best of your ability. So when a person says, Hyacinth, should I get an interest only loan? First thing I'm doing is where are you at consciously? Because you're not about to have me tell you the pros and the cons of an interest only loan. And then you go back and say, this wasn't good for me. This wasn't right for me. If you want to stay regular, stay regular. So the answer to your question is an interest only loan could be beneficial for someone who is not emotionally tied to having a paid off house. They're saying, I want to live in this house. I want to pay the lowest interest rate possible while I'm here because it's housing and I can't take it with me. And if I want to leave it to my family, that's why I got life insurance. So when I go on to the next lifetime, they could pay the house off and do what they will. While I'm here, I want to be in this baller house and not pay the most money, because the money that I will be paying towards principal and interest, that principal's payment, I'm gonna put that towards an investment. Does that answer your question, or did I get too deep?
Yeah, you got deep.
All right,
Okay.
well, welcome to the jungle.
I know you
baby.
like to get deep, but let me give an example.
Welcome to the jungle, baby.
Okay, let me give an example. Okay, so I like to give examples. Okay, so here's a piece of property that this person says this piece of property costs $500,000. And if I put down 20%, which would be 100,000, then that means the balance would be $400,000 mortgage. That $400,000 mortgage is going to cost me, $4,500 a month, or let's say $5,000 a month out the door. And that $5,000 a month, this says it's going to be $60,000. So that's what it's going to cost me for a $500,000 property. I put down $100,000. I finance $400,000. It's going to cost me everything about $5,000 a month. And that's because I'm paying principal and I'm paying interest. But if I do it interest only on that same situation, on that same $500,000 property, and I put down $100,000, that property may cost me $3,000 a month, but I'm only paying interest. So what I mean by that is I owe $400,000 and I'm paying $3,000 a month. The only reason why I would do this, because even though I bought the property for $500,000 and I'm only paying not $5,000 a month, but $3,000 a month, my payments are lower. I happen to know that in 10 years, this property is going to be worth $1 million. Because property values is like Hyacinth and Tavares think, the property values are going to continue to rise. I don't really care about paying that $400,000 off. I already got $100,000 equity that I put down, and my payment is only $3,000 opposed to $5,000. So I qualify even better because I could pay $3,000. But I do know the property values are skyrocketing, and that property is going to be worth $700,000, $800,000. And if I wanted to sell it, I can get all the equity. I still made money, and I had lower payments.
And I had somewhere to live.
Excuse me?
And I had somewhere to live.
And I had somewhere to live. So really, a lot of people bust their butts trying to pay off a house that got 4 walls in it to live in it. When houses, remember this now, I want y'all to understand, housing, when you pay a house off, you don't get any money when the money's in the dirt, in the walls. That's not an investment. You might as well just bury the money because you're not earning 1%. You're not even earning a half 1%. All real estate housing value goes up based on the appraised value, market value, not how much equity you have in it. Not saying how much money that you done paid off. No. So paying off a house is not really a smart thing. It really, really isn't, because you've taken that money and taken it out of the game. The money not working for you no more. When you pay it off into the house, it's not earning anymore. You always want your money to earn money, to be working for you, right? The bees work, your blood vessel works, the flies work, everybody work, everything's supposed to be working and doing something. But when you put your money and pay off your mortgage, you take it out of the game. It ain't working no more. It's not an economic sense. It's dead money. And worst thing is you want to try to tap into it, and it can be hard because you got to qualify for it. So the pros on getting interest only loan is phenomenal, especially for cash flow, interest only loan. The con is you're not paying off the principal. and you might not care to pay out the principal. You just want. A lot of people say, "Listen, I'll borrow $1 billion if you tell me I only got to pay $10 a month." Who won't? Is anybody out here? I'll borrow $1 billion if you tell me the payment is $10 a month. Give me the billion right now. Give me the billion right now. So if as long as you could, if there's a way that I can do something and you can tell me a way to make my payments lower, I want to know about that. The problem is the average layperson, citizens, all abiding citizens, don't know what to ask for because they don't even know what's available out there. Right. And I think it's such injustice that we're not educated on the different moves and the strategies and the chess games that you can use, and they keep you ignorant because you don't know. And if you don't ask anybody, and you only people who you're around, they don't know, so you don't know. And so that's why it's important for you to come to the Henderson Financial Group so we can tell you stuff that you don't even know that you don't even know that you didn't know. Make sense?
Most definitely.
All right. So I know Smart Money is still doing interest-only investment loans. Have y'all seen that, or that's still hitting and only Smart Money people are doing that?
Pretty much only Smart Money. Pretty much only Smart Money, because most people hear interest only and they run the other way, right? Because they think it's a balloon payment at the end, right?
Yeah.
And most people, honestly and truthfully, that extra money that's left over each month, that extra $2,000 in your case,
yeah,
most people wouldn't invest that money,
right? And that's spend it,
right? And that's the key.
Yeah, that's the key.
That's what makes it. The magic works, right? So yeah, it's reserved for a certain mindset of people, as Heisey mentioned.
I got another question for you because I know that we run out of time. But when you get a mortgage, and most people really care about if they got a 0.5 point lower, or they want to buy it down, or 7%, but they can get a 6%. They jump for it. Is really is the secret sauce in the interest rate or how the interest is applied to the mortgage? Tell us more about that, because they really confuse us. Most people want low interest rate. They say housing's, interest rate's too high, so I'm not going to buy a house. Buying a house, should it be based on what interest rate you get or how the interest and principal payments are being applied to the loan? What do y'all think?
I'm glad you asked this question, right? As in 2020, when they dropped the rates to 3%, that caused a lot of people to go out and buy houses because the rates were low, right? And these people bought houses that they can't afford because of the interest rate. And you don't want to buy a house off of the interest rate. The interest rate is pretty much smoke and mirror. It really doesn't matter. It's going to go back to what Heisey said earlier, affordability, right? On a monthly basis, can you afford this payment, right? And still live. The payment is not choking you on a regular basis, right? So if the bank is telling you that you can get this loan for 6%, right? Right now we're in a 7.5%, 8% market. So a person may jump on that and say, that's a good interest rate, quote unquote, good interest rate, right? But like I said, it's not so much about the interest rate, right? It's more so about how your payments are applied to that interest rate or how your payments are applied to that mortgage. What I mean by that is, if you have an interest rate, 6% interest rate on an traditional mortgage that's amortized, right? So what that means is, what I spoke about earlier is your first 13 to 15 years, most of that money is going towards interest only. It's going towards that 6%. I mean, it's going towards profit for the bank, right? So it's not really benefiting you. It just looks good, right? It gives you a bragging right, but it's not really benefiting you.
So is it safe to say when they say that your interest rate is 5%, 4%, 7%, you feel that's how much interest that you're paying on that loan? I have found that to be falsehood, because you wind up paying far more. People are paying 75 and 80% interest on the unpaid balance on the loan. Because if you look at the end of the year, everybody look at their statement at the end of the year, and you see how much interest that you've paid based on that yearly, monthly payment. It's far more than 6%, 7%, 10%. Even if they say you're only paying 4% interest on your loan, you wind up paying much more. They Jedi mind the general public, and that is, I think, an economic crime.
Oh yeah. So if you buy a house at a $400,000 house at a 4% rate, your total interest cost is going to be over $200,000, right? So you bought the house for $400,000 and you're going to pay over $200,000 in interest.
Financing it.
Financing it. So you're going to pay $600,000 for something that costs $400,000, right? That's equivalent to buying a pair of shoes, right? If these shoes are $200 and you know they're $200, but someone's trying to charge you $400 for a $200 pair of shoes, right off the back, we're going to say, I wouldn't buy that. I'm just going to get them for $200. But when it comes to purchasing property, you got things that are hitting the interest rates to make you do things that you wouldn't normally do, to make you make decisions that aren't bright or that's not the best move for you, right? Yeah.
Because I looked at one. They said, okay, the monthly payments is $2,300 a month. So I say, okay, $2,300 a payment. How much is going toward the principal, paying down the loan, and how much is going toward interest? Well, they say $2,000 is the interest payment. Well, hell, out of $2,300, you telling me I'm paying $2,000 in interest and only $3,000 going toward paying off my house?
Yeah.
That's more than that rate. That's more than 5% or 6%. That's more than 10%. That's 75%. And this is what people don't understand. As a matter of fact, this is what they have Jedi mind us and duped us into believing. That's why mortgage companies, banks, man, I tell you, they say, that's where all the money is. It's amazing. But that's why I want you guys to look at that and understand. And they legally do this. And they wear shirts and ties and dresses and look pretty and, and they just conning you. I guess if Jesus came back, they'll say, Jesus say, you hypocrites. Whoa, you Pharisees. It'll be the same thing over and over, but it's business and it's money. We got time.
Yeah, I was gonna say you got to ask questions. You have to take accountability and responsibility and ask questions, and then we see it sometimes too, right? So people come to us, the expert, and we ask them questions, and they ask questions, and we give them answers, and guess what they say? No. They still give it to me this way. Give it to me the traditional way. So I love the conversation about interest rates. This is why one of the new laws that was passed, thanks to RESPA, is you cannot quote interest rates without quoting the annual percentage rate. Back in the days, you could quote interest rates. I got a 4%. You can't do that anymore. Well, it's against the law to do it. People do whatever they want to do. But if you do, you must talk about the annual percentage rate. Before we go, when you're thinking about qualifying for a home, refinancing, purchasing, whatever it is that you need to do, think about this. Understand that it's what it comes down to is affordability, because I know we're entering the holiday season. You're going to be gathering, and there are going to be people who are not subject matter experts. They may be a subject matter expert at something else, let's say medicine or auto mechanic or something else. But since you're gathering during the holidays, they may put on their financial subject matter expert cape. And you may be saying, hey, I'm going through the mortgage process, so I'm thinking about buying a house. And all of a sudden, they're a surgeon by day, but during the holidays, they're going to tell you interest rates are too high. Don't do this, don't do that. So be very, very careful with that, because it is about affordability at the end of the day. And an interest rate cannot alone tell you what affordability means to you. Affordability is based on each and every individual. We didn't talk about property taxes and insurance this show, but that's something that I talk about with everyone who I speak with when it comes to mortgages. I know you want this amount of house, and I know you only want to pay this rate, but have you thought about the property taxes and insurance yet? Because if you didn't, that's going to give you a wake-up call. And one last thing I want to add before we go is, if you are shopping mortgages and you want a 0.5 point lower, do not call me. do not. I am not working your mortgage loan based on interest rates. At the Henderson Financial Group, we work your mortgage loan based on more than that. And at that point, the juice is not worth the squeeze. If you are shopping interest rates, we are looking for relationships and clients who want to do business with us because they see the value in what we offer, and it goes beyond an interest rate.
And before we go, I got to answer this question, because Denise Ward says, does the mortgage payment increase? We're talking about the all first mortgage HELOC. Y'all answer that question. Does the monthly payment increase?
So it all depends, right? It depends on your scenario. Are you just going to do a regular refinance where you have the HELOC pay off your traditional mortgage and you're not going to do any cash out? So it's going to vary. So what I would say is, Ms. Ward, please, give me a call and let us run a scenario, and and we'll see what it looks like in your situation.
Yeah, and generally speaking, it's not an increasing loan where your payments are up and up. As a matter of fact, once you know how to work the system, it's a good chance your payments can go down. So it just depends on how you work the system, but you'll have more control. I tell you what. And once you learn this new type of mortgage, I promise you, man, your eyes will be open. You'll be like, why didn't I know this? And that's why it's good to tune into the Henderson Financial Group with our websites. Come to our website and also come to our shows. This has been a great show. I'm glad I dropped into you guys. I hope I didn't just talk too much and really put y'all on the spot, but y'all handled it pretty well. I'm very proud of you. And y'all keep up the good work. We also let me see on Wednesday, Jay, Nat Heisey, you tell the people what's coming up next. Today is Monday. So then Wednesday we got our show.
Oh yes, I'm traveling Wednesday. I think I can do it. I may be able to do it right before I.
Oh, you're traveling?
Here.
Okay.
We may do it. I think I can do it from home and then Scooter promptly at 12 o'clock. Promptly at 12 o'clock this Wednesday, 12 o'clock on the dot. We are going to do.
talking. We're talking. Look who's talking.
Not late. We're going to be on time all the time. 12 o'clock on Wednesday. Mortgage Minded, no. Transitions with Hyacinth and Robert Henderson Jr., certified financial planner, certified tax code of the Henderson Financial Group. So today's Monday. Thank you all so much for joining us for Mortgage Minded Mondays. It was an absolute pleasure having you here, Mr. Henderson. We love the questions. Well, I love it. I want to say we all know about T.
Well, he loved it too. Come on.
Let's go.
Yeah,
I know, but we and I'm sure the audience loved the questions that you brought to the show. If you have not watched the entire episode, make sure you run the tape back and watch the entire episode. And sometimes you have to watch things and listen to things over and over again. I briefly talked about increasing consciousness. It's like a little groove. When you walk through a certain spot in a grass, the more you walk through it, the more the indentation happens. That's how it works with your consciousness. So thank y'all for joining us. Mr. Henderson and I will be back on Wednesday at 12 o'clock sharp. Okay, maybe 12:05 sharp for transitions. And then on Saturday, the Understanding Money Show with Henderson and James T. Thomas kicks off at 9 a.m. this Saturday. All right, until next time.
Peace, love, and happiness. Please be safe. Thank you. Have a wonderful day. Peace.